Chuck, here we are midway through 2014. Why don't you give us your perspective on the investment performance at the Royce Funds?
We've had a very promising first half. Our year-over-year performance, 12-month performance through the end of June, virtually two-thirds of our funds have beat the average in a very strong period, a plus 20% period.
Talk a little bit about the March 4th peak and then the ensuing decline. It was about 9.1% into the middle of May. It was a very interesting period for the Royce Funds because of the differentiated performance, but talk a little bit about what you saw in that time period and why we candidly did as well as we did.
In a sense, it was a classic perfect market for us. The more speculative areas collapsed, biotech and the internet area, and some of the higher multiple stocks did very poorly during that period. Those stocks were down 10, 20%. Our more kind of vanilla stocks did perform very, very well. And it was the first time in a while that we performed the way we like to think we can perform.
2013 was a very interesting year in that it was the first in over 20 where the Russell did not experience a decline of greater than 10%. We've already had 3 declines of 8-ish% thus far this year. Do you think that is more indicative of the pattern going forward, and is that just a more normal market that can candidly be beneficial to our discipline?
Absolutely. I think it is a more normal market to have routine, smaller corrections. The 5 to 10% correction is a very normal pattern. I definitely see that happening in the context of more normal returns. More normal returns being 5 to 12% returns. I think we're settling into that zone right now.